Tesla Inc. is currently trading at exactly 402.73 USD, posting a gain of 1.48 USD, or 0.37% in today's intraday session. If you're watching the broader indices right now, you are likely seeing a sea of red across the Magnificent Seven, with the NASDAQ pulling back as bond yields tick higher. Yet here sits Tesla, flashing green. That is the expectation versus reality moment right there. The expectation is that Tesla, a high-beta tech stock, should be leading the sell-off on a risk-off day. The reality is that the market is beginning to sniff out a structural shift in the company's valuation model that has nothing to do with selling cars and everything to do with the successful pivot to an autonomous economy. This 0.37% move isn't just noise. It is a signal of relative strength in a market that is punishing pure-play software names while rewarding companies with tangible, physical AI infrastructure. To understand why Tesla stock is defying the gravity of today's market, you have to ignore the headlines about quarterly delivery misses or price cuts in China. Those are legacy auto metrics. The smart money, the institutional volume we are seeing on the tape today, is positioning for the Cybercab reality. Most retail investors are still obsessing over the Model 2, the rumored $25,000 car that was supposed to kill the Toyota Corolla. The expectation is that this car is delayed or canceled, signaling failure. The reality, which we need to dissect carefully, is that the Model 2, as you imagined it, a smaller, cheaper Model 3, is effectively dead. But it has been replaced by something far more lethal to competitors. A hybrid strategy of stripped-down Model 3 and Y variants produced on existing lines for immediate cash flow and the dedicated Cybercab Robotaxi for the future. This is not a retreat. It is an aggressive capital allocation pivot that saves billions in new factory ramp-up costs while bridging the gap to full autonomy. Let's break down the intraday volume because it tells a fascinating story. We are seeing elevated buying pressure at the $400 psychological level. Every time the price dips below this line, it gets bid back up. This suggests that 400 USD has become the new line in the sand for institutional accumulation. When you look at the order flow, it is not the frantic, high-frequency scalping of day traders. It is the steady, block-size accumulation of funds that are likely reweighting their portfolios for 2026. They are looking at the recent Arizona regulatory approval for ride-hailing and realizing that the regulatory moat is actually being crossed faster than the technology moat. Tesla receiving a transportation network company permit in Arizona on November 17 isn't just a piece of paper. It is the firing gun for the commercialization of the Robotaxi network. Now consider the terms Tesla stock narrative in the context of the terms investing sites discussion. If you go on any forum or read any analyst note from a traditional auto analyst, they will scream about compressing margins, and they're right. Automotive gross margins have fallen to around 15 to 15% excluding credits. That is the expectation. But the reality is that Tesla is no longer optimizing for automotive gross margin. They are optimizing for installed fleet size. Every car they sell today, even at zero margin, is a Trojan horse for high-margin software revenue tomorrow. This is the razor and blade model on steroids. The blade isn't a disposable cartridge, it is a software update that turns your car into a money-printing robot. The market is slowly waking up to the fact that a 5.8% operating margin today is acceptable if it secures the user base for a 70% margin software business in 2027. We have to talk about FSD, full self-driving, because this is the heartbeat of the valuation. The release of V13 and the transition to V14.1.5 is not just an iterative update, it is a fundamental architecture shift to end-to-end neural networks. For years, the expectation was that self-driving was always a year away. The reality of V13 is that the interventions per mile metric is improving logarithmically. We are seeing the software handle complex urban environments, construction zones, unprotected left turns, erratic pedestrians with a fluidity that feels human. This matters because the take rate for FSD is the single biggest lever for Tesla's profitability. If the software gets good enough that it becomes a must-have safety feature rather than a nice-to-have party trick, the revenue implication is billions of dollars of pure profit dropping straight to the bottom line. Let's shift gears to the energy division because this is the silent killer of the bear thesis. While everyone argues about whether the Cybertruck is ugly or not, Tesla energy business grew deployments by 81% year over year in the last quarter. We're talking about 12.5 gigawatt hours of storage. To put that in perspective, that's enough power to power a small country. The Megapack factory in Lathrop is ramping, and the Shanghai Megapack factory is coming online. The expectation is that Tesla is a car company with a solar side hustle. The reality is that the energy division is on track to become a Fortune 50 company in its own right, providing the critical grid stabilization needed for the AI boom. Data centers, which are popping up everywhere to train models for companies like OpenAI and Google, need massive amounts of reliable power. Who has the best utility-scale battery solution? Tesla. This is a B2B revenue stream that is completely uncorrelated to consumer interest rates or auto loan availability. It creates a floor for the stock that simply didn't exist 3 years ago. I want to pause here and ask you guys a question. Comment below how many shares of Tesla stock you currently hold, and be honest, are you holding for the cars or are you holding for the robots? Do you think Optimus will eventually be worth more than the car business? I see a lot of debate on this, and I want to know where you stand. Speaking of Optimus, we cannot ignore the humanoid robot in the room. The recent updates on Optimus Gen 3 are mind-bending. We're seeing the bot perform useful tasks in the factory, moving battery cells, sorting parts. The expectation is that this is a sci-fi pipe dream, a distraction for Elon. The reality is that labor is the single biggest cost in manufacturing. If Tesla can deploy 1,000 Optimus bots in Giga Texas by 2026, replacing human workers for dangerous and repetitive tasks, the unit economics of the car business change forever. It isn't about selling the bot to you to fold your laundry, yet. It is about using the bot to build the car for half the cost. This internal use case justifies the R&D spend immediately. The market assigns almost zero value to Optimus right now. If that changes, if the market starts pricing it like a startup within a startup, the upside from 402 USD is difficult to calculate because the TAM, total addressable market for labor, is effectively infinite. Let's look at the terms Fidelity Investments or terms Schwab Intelligent Portfolios perspective. If you are a passive investor, you own Tesla because it's in the S&P 500. But if you are an active manager, you are likely underweight because the valuation metrics PE ratio look insane compared to Ford or GM. This under-ownership by value funds creates a coiled spring effect. As Tesla's earnings mix shifts from hardware to software and energy, the volatility of the earnings will decrease and the quality of the earnings will increase. This will eventually force the conservative terms Fidelity mutual funds to buy back in, not as a growth play, but as a quality compounder. We are seeing early signs of this with Nomura increasing their stake recently. They are not chasing momentum, they are front-running the fundamental shift in the business model. The terms Robinhood stock trading crowd often gets a bad rap for being dumb money, but in Tesla's case, they have been right more often than Wall Street. They understood the brand power and the ecosystem lock-in before the analysts did. Today, however, the retail sentiment is mixed. You have fatigue. People are tired of the Elon noise, the political tweets, the X, formerly Twitter distractions. This fatigue is real, and it caps the upside in the short term. But for the cold, calculating investor, this noise creates opportunity.
You're buying the engineering team, the data advantage, and the manufacturing infrastructure, not the CEO's social media feed. If you can separate the signal from the noise, the asset at 400 USD offers a risk-reward profile that is rare in mega-cap tech. We also need to discuss the terms interactive brokers trading data regarding short interest. It has been creeping up again. The bears are emboldened by the stalling EV demand globally. They're betting that the air pocket in demand before the next wave of vehicles arrives will crush the stock. But they are missing the regulatory credit angle. Tesla dominates the regulatory credit market. As other automakers fail to meet their emissions targets because they're scaling back EV plans, they have to pay Tesla. In Q3 alone, this was a massive profit center. It's free money.